record of the CEO and our comfort level with how honest and true their business model seems, meaning like, is this a successful business that's proven? Is this a successful CEO that's proven? That's most important. And we look at that above the structure, above the promised returns. And a lot of the most sophisticated families I know, they don't care what the CEO promises. Anyone can promise to 10x their money. It's really about how sure are you that the value they're providing in the marketplace and to you is rock solid, and they're going to see through any bumps in the road. And then once you have that confidence, you can structure a deal around it. So when I'm looking at a deal, I first look at that team, but then I focus in on the structure and try to figure out, can we do seller financing? Can we do different LLC share classes? Can we ask for collateral? Many times someone will say, oh, will you invest in my company? And be like, and they think it's going to go up 5 times, but they're going to give you this big valuation. But if it doesn't go up 5 times, then you should have owned their whole company for the amount you invested, because their valuation was based on going way up, right?
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9-figure businesses. We interview top-level 8 and 9-figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9-figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans, and boy, you guys are in for a treat. Now, if I told you that this next guest interview people like Mark Cuban, Jay-Z, Grant Cardone, has almost an ecosystem of 2,700 active investors, would you listen to this podcast? You bet your ass you will. Plus, you'll probably share this with all your friends, all your colleagues, because this is going to be a bombshell kind of podcast. Because we have this next guest, which is the CEO of Centimillionaires. He's also Centimillionaires Advisors, LLC. He's also the owner of Billionaires.com, providing performance-based family office solutions for $100 million net worth families. He's also the founder and the head of both commercialrealestate.com and the Family Office Club, which we're going to be unpacking here shortly. The largest community of registered family offices globally, with over, like I mentioned, almost 2,700 private investor members, which we're very excited about. In addition to having 6,500 participants, attended 25 live conferences and hosted per year. Plus, he's spoken in over 250 times in 14 different countries at industry conferences all over. He's also has the #1 best-selling book, most listened to a podcast, and he has authored several books such as, let me just share with you real quick, The Single Family Office, Capital Raising, Pitch Decks, How to Start a Family Office, and so much more. Please welcome my friend, Richard C. Wilson. How are you doing today, Richard?
Great. Thanks for having me here, Christian. Appreciate it.
Well, my man, I'm really excited about diving into this, but I want to lay out this real quick. It's funny because I was listening to one of your interviews, and you go to some of these, your family events, and when you tell them what you do, they always think, oh, you just set up family offices in people's houses. And I love to just set it out straight. I thought that was really funny, man. My man, what is a family office? Help us understand that.
Sure. A family office is a wealth management solution for someone who's ultra wealthy or has, $7-10 million or much more, 50 million, 100 million plus in net worth. And there's a lot of them out there, right? There's over 75,000 people worth $100 million or more. But once you start investing in more than just 1 or 2 residential rental properties and not just have money in the stock market and start doing angel investments or buying real estate assets, you start to have the need for a family office. And to drive the point home, if you're worth $10 million and you make one mistake, that one mistake might cost you $50,000 or $100,000 in extra taxation or in a missed opportunity, et cetera. If you're only worth $1 million, you make a mistake, maybe it's only a $5,000 mistake. So maybe you don't need all those systems and people around you. So the need grows as you grow larger because the cost of a mistake grows larger. And when you have 100 LLCs, quite likely that you're going to mess up something small on one of them at least.
Well, it was interesting. So I went to your website there, singlefamilyoffices.com. And in that, you obviously give out your amazing book. And had the opportunity to read that, unpack that. And what was incredible is you really just laid out the whole foundation, certain questions that these individuals need to be asking themselves to develop, whether it's the chief investment officer, whether that's a CEO, whoever it is, whoever you have in your team to make sure you facilitate the right family office, the structure, et cetera. Now, I want to ask you a little bit because you've been able to come alongside, internationally, families, right? A lot of
Right.
people, and you've learned throughout the whole journey. And I believe there are certain one or two pivotal moments throughout this journey. And I want to ask you, Richard, what were those pivotal moments, whether it was a big loss, whether it was a big frustration, infrastructurally that helped you evolve to the foundation that you currently have?
Sure. One of the biggest moments was realizing that everyone running the family office conferences 12, 13 years ago, after speaking at a lot of them, didn't really work in the industry. They're big media companies. And when starting to host the events, the light bulb also went on that I should stop listening to people who are not family offices. And if I want to be ultra wealthy, I should listen to the ultra wealthy. That sounds super basic, but everyone will criticize you in business if you do more than one thing typically. And they tell you to focus. But the family offices who are ultra wealthy would come to one of my conferences and say, oh, well, of course, this isn't your main business. The real value is doing business and doing deals within the relationships you build from the room, right? Like that's the real business you're in, right, Richard? And I would have to say something like, yeah, I'm still figuring that part out, but of course, that's what I'm trying to do. And then I thought to myself, man, I need to figure out this deeper business model. So that was a real turning point. It was just that listening to the ultra wealthy and then not hosting events to be an event company, but to grow a community and to build expertise. And then the second thing was really realizing that, like when Einstein won the Nobel Prize, people said, oh, wow, you discovered relativity. Aren't you proud of yourself? And that's amazing. And he said, well, I didn't discover it. People were studying this before I was born, but I just worked on this and nothing else for 10 years. And so now that I've been doing this for 15 years, I find there's not very many people who do anything for 15 years or even 10 years. And so now that I've published 13 books and we've hosted 185 live events and we have all these media platforms, it keeps on growing on itself because of that momentum. And that really long-term focus really clicked when I was speaking at an event in Monaco early on. And I had a hedge fund blog where I talked about family offices, capital raising, as well as hedge funds. And people were calling me the hedge fund blogger guy. And I was like, hedge fund blogger guy. And everyone recognized me and say, oh yeah, I read your hedge fund blog. Oh yeah, I'm subscribed. And I was like, man, I don't want to be known as a hedge fund blogger guy. That's like the worst positioning in the world. So I decided then, probably in 2009, 2010, like, okay, I'm going to position myself as the family office expert, not the hedge fund blogger guy. So that was kind of a turning point as well to realize.
Well, what's interesting to me is in your book, you're able to share the methodologies, the principles that stand the test of time, how to structure it, like I was talking a little bit about. And, I've got a few, points here, but I'd like for you to just maybe mention a few things that resonated with you the most regarding how to, because what I realize is those that are looking for, to raise capital for their project, for their fund, whatever, investors, they have to understand how the family office operates and what they're looking for, their pain problems. And in this book, you were able to really solidify, hey, these are the pains that they're, struggling with. And some of them have an active, website, some of them don't, but they're still infrastructurally established. So I'd love for you to just kind of, share a little bit in that book.
Yeah, sure. One of the pain points is control over deals, the structure of deals, the control over their financial situation. They're entrepreneurs, so they created their wealth usually through building a portfolio of real estate or an operating business or many operating businesses. So then to retire on the beach and hand it all over to Goldman Sachs to manage for them is typically not in their blood. They may want to have a few wealth advisors manage their public market stuff, but they like to be involved in some of the real estate work. And that's the second component of their portfolio typically. And then the third component is investing in operating businesses where they like to be the most involved, at least the capability to be the chairman of the board or CEO temporarily as needed. And so structuring deals in the right way and structuring their attention to things so that they don't say, I need to control everything in my investment portfolio. Like, no, you don't really want to be on stock earnings phone calls and be trying to control all of that, but use your brain where it's best to play offense and then hire the right team to help you play defense and allocate to the right real estate transactions if that's not where you made your money, et cetera. So that's one of the biggest things that comes up. And someone who's worth $400 million, they don't have all the answers. It's their first time being worth $400 million. So they almost all make the same mistakes when they become ultra wealthy.
Well, what's interesting also is, you mentioned, and I think this is like a misconception that I had definitely when I got in the investment world, is these family offices, they have an investment thesis. And a lot of times, because maybe they made their wealth, like you just mentioned, in real estate, maybe commodities, whatever it may be, right? Maybe even, micro with, hospitality and the real estate, right? Whatever that is. And they tend to stay in that because they're already very familiar with it and they hire those individuals. I'd love for you to just talk a little bit about that. For those that are investors that are looking to raise capital from these family offices, making sure that maximizing everybody's time and not wasting everybody's time if that investment thesis doesn't align.
Yeah, for sure. It's so important. So a partner at Goldman Sachs once asked me, how do you hunt down all these family offices? And my answer is really like, well, I don't hunt them down. I just want to look like the Excedrin on the counter when they have a migraine and they're reaching out for it, because then they're reaching out to me for help and they're calling me and emailing me about how I could help them. And so that's one mindset that's helped me a lot. The other thing is that if you add value to somebody first, you de-risk the transaction. So helping somebody gain a new client, or helping somebody's son, or helping someone source an opportunity first before you're asking them for a favor is the way you make it in their best interest to engage with you. So when I moved to Scottsdale here, I went to a service business that had a subscription model. I thought, oh, that's a cool business model. I went to their website. I saw they had 17 locations. I said, okay, it's probably a wealthy family. And I reached out to the two co-owners cold via LinkedIn separately. They didn't know I was messaging both of them. And they both replied the same day. And I found out they had just sold to Goldman Sachs for $140 million. And they were starting a new platform in another state. And it was my first week in town, and I was able to meet with that family and meet their board, et cetera. But I sent them a message that was in their best interest to reply to me. So adding value to others first is an automatic, and then providing value and thought leadership is something that we always do all the time. And then really thinking long-term and structuring investments so that it maximizes alignment. Like when we do a medical practice investment, we're getting investors paid back off the top line revenues, typically gross revenue royalties, and we invest only into profitable US-based medical practices. And then the investors typically are doubling their money, and then they're left with a little bit of an equity kicker for some upside potential in case they sell to private equity, so they're not capped at 2x. And then in our Airbnb division, we have an Airbnb fund, and we don't charge any asset management fees. We just cap their returns at 2x, and the investors double their money and get a 2x return before we make a dollar. And maximizing alignment is so critical. And that comes down to custom structuring deals. And so I think that mindset of adding value first through thought leadership or interpersonal interactions, and then adding value first within a deal so that the investor wins before you charge them a bunch of fees. As common sense as that sounds, that's not how the whole industry works, right? So everybody else charges fees because they have to keep the lights on. So I don't blame them, but those are some of the top things for getting deals done with families.
So this is a really good point. I'm glad you're bringing this up, Richard, because I see this all the time. And I come from more of the marketing world, and it's very interesting that a lot of them are very performance-based lead generation, for example. Hey, you only pay if you make a sale, et cetera, et cetera. And I always love that because obviously they have some skin in the game and you play differently. We all know that. And so you structured, and I want to ask you a little bit, because was that an evolution? Did you realize, or was that like you started in fee-based and then all of a sudden you got into more of the performance-based because you realized, hey, that's just a win-win situation all around? What was that evolution look like?
Yeah, I just hate doing what everyone else is doing. So I just want to be commoditized. And then I just thought well, what's going to remove the friction of working together? And so it started out because I was charging families $7,000 a month to set up the family office for them if they need that help. And we wrote a book called How to Start a Family Office. You have a copy of it somewhere here. And we used to charge them this retainer. And what I found is that some families would engage and they're worth $400 million. We loved working with them. Some families we get all hung up on, well, what's the cancellation clause? Well, how many hours of your time do we get per week? Or what about this? What about on page 7? What if we had this? And it just took months, or just add friction and just be this annoying process. And then meanwhile, our core business grew. And I realized the relationship with that family was worth so much more than the $7,000 a month. I was like, forget the $7,000 a month. I'll just help you for free. We'll set up your family office. If we like each other, it's easy to do business together. I'm sure it will close deals together, et cetera, and we'll make money long-term. And I realized trying to charge the client short-term was messing up our ability to do business long-term. So that's really what was the main turning point in doing that. And now we just try to do that across the board on everything. And the other reason why we do it is in our industry, if you help somebody run a family office, they might pay you 100, 200, 300, 400,000 a year base income, and maybe discretionary bonus, maybe bonuses for getting certain things done. But if you help them source and structure and close and manage a deal, you might get 10% of the upside in the profit share in that, or a little equity piece. And what we tell families is that we don't need a base retainer. We don't need a base salary. That's what my core business makes us money for. We just will do the work only for the upside part.
Okay, so this is good. Very, very good. So you play the long game, which definitely makes sense. And you mentioned here performance-based. What are certain things? Because like you mentioned, gross revenue royalties, something associated with like the gross of it, the revenue, the growth of it, excuse me, where you're able to make some, some income consistently, but also the structuring it. Are there certain things when you go into a deal that you're like, hey, I kind of want in this situation contextually, I want some equity, or hey, maybe I want more of just attached, our structure or deal to more of the royalty aspect of the growth and et cetera. Is there certain things the way you look at it contextually? Help me understand how Richard looks at a deal.
Yeah. So we do a 5.5-hour workshop. I'll try to answer this in like 40 seconds. So I'm not long-winded. So I love this topic though. We've done 12 gross revenue royalty deals. I always look first if it's possible to use royalties. And I'll look at whether we can get an equity warrant or a right of participation at the sale of the company, but also get our money off the table quick so we can recycle it into another deal. And a critical moment of time is either when you get all of your investment off the table and now your deal is de-risked for you. So maybe you have less equity in the deal now or less upside potentially. And then the other critical moment is when you hit some return threshold where you're happy with that return, like whether it's a 2x return or whatever, and anything else above that is just pure gravy and really a cherry on top. So we structure deals around those components. And sometimes we'll have it so investors are capped at a 2 or 3x return. Sometimes we'll have an equity warrant or right of participation that goes from 10% down to 5%, or like with one manufacturing company, I get 18% of the exit price, but after I get 1.2 times my money back off a gross revenue royalty, I only get 16% because it's de-risked now. I got all my money back and then some already. And so when we look at deals, what's most important to us is the quality of the team, the track record of the CEO, and our comfort level with how honest and true their business model seems, meaning like, is this a successful business that's proven? Is this a successful CEO that's proven? That's most important. And we look at that above the structure, above the promised returns. And a lot of the most sophisticated families I know, they don't care what the CEO promises. Anyone can promise to 10x their money. It's really about how sure are you that the value they're providing in the marketplace and to you is rock solid and they're going to see through any bumps in the road. And then once you have that confidence, you can structure a deal around it. So when I'm looking at a deal, I first look at that team, but then I focus in on the structure and try to figure out, can we do seller financing? Can we do different LLC share classes? Can we ask for collateral? Many times someone will say, oh, will you invest in my company? And be like, and they think it's going to go up 5 times, but they're going to give you this big valuation. But if it doesn't go up 5 times, then you should have owned their whole company for the amount you invested, because their valuation was based on going way up, right? And so many times when we invest into a medical practice deal, we're asking for medical equipment collateral, insurance receivables, and just using a lot of creative deal negotiation strategies.
So with this being said, because it sounds like to me, you are very industry agnostic in regards to the deal flow. It's really based on the founder and the team, as well as the proof of concept. Now, is this where you like their Series A, Series B, or they're like more of growth stage? They got proof of concept established, they got some revenue, maybe they're $1 million EBITDA and more, et cetera. What does that look like? Just so, or is it very contextual?
Yeah. So there's really only 3 areas we look at deals in. 1, multiple location medical practices that are profitable. And that's in the operating business world, of course, medical and dental practices. 2, Airbnb properties in the real estate world. And we buy those, own them, and manage them directly. So those are our 2 really big areas of focus. The only third thing we do is we listen to our 20, 50, $100 million net worth clients who made their money in manufacturing or stem cells, et cetera. And if they say, hey, look out for a golf company we could buy or something like that, we'll listen to our top clients because we're just serving them. And we'll source from our investor club and the 15 live events we do per year at the family office club. We will source deals that hit their strike zones and hit their buy boxes. But us personally on our balance sheet, it's all about the medical practices and the Airbnb assets because they're both cash flowing, stable, sleep at night. They're not going to go binary on you and go out of business randomly. We're not trying to 30x people's money, and not high debt, not high leverage. And I can be more aggressive on moving quick if my deals are conservative, cash flowing, and profitable. And they both sell at good multiples once you have a big package of them. So we are actually very focused on those two areas and then just listening to our clients on what they're asking for. So like our biggest client's a billionaire. We've done 19 transactions with them, including $55 million of deals just this year with them. And then one of my smaller clients is a $20 million net worth brother and sister. We just got off the Zoom call with them, and we've done 7 transactions with them and put several $1 million of their money to work. But to go back to your question about startups and Series A and B, I don't personally invest into any startups. And I tell my families, maybe you want to allocate to a venture fund to fund or a angel investment fund to fund, et cetera, to get exposure. But unless you made your money in that industry, you probably should not be taking the massive risk of a startup or seed capital. A lot of people become wealthy. They start spreading their money all over the place, diversifying into all these different industries, mostly startups, somebody's dream that just needs to be funded. And then they lose a ton of money by doing that. So we encourage people to invest in high risk things only in the industry they know best, so they can help play defense and offense on that.
So I've heard founder and team investors really emphasize that when they're looking at a deal. And I would love to get your perspective on what you look for. I know you mentioned maybe some founder or the team has had previous exits, or maybe they're very familiar with that industry for 15, 20 years. They've got kind of a resume, if you will, established. Is there anything else that you look for when you're looking at kind of a synergistic founder and team to make sure, hey, this is a good investment? What does that look like?
Yeah. So I run the other way from people who are stressed out and rude all the time. Like one guy just yesterday, twice I started to write him back and I was like, no, it's not worth it. Like just delete the email. But, I was really busy traveling this week and I said, oh, can you please connect with Laura as a first step, just to get to know us as an organization? Because he wanted to work together. He wanted me to join his board, but it didn't look like a great fit. And he really was insistent. And his reply back was like, no, I don't talk to people's staff. I only talk to the owners of companies. And I wanted to write back, okay, well, then I can never introduce you to a single family I work with because you might be rude to them as well. And they might want their underwriter or their CIO to talk to you or whatever, right? So sometimes people are just rude or not professional, or I'll ask for their questions over email because I'm traveling and they'll demand I get on the phone without giving me an agenda for the phone call. And I'll say, okay, well, it's just not a fit, et cetera. We get investigative background checks on potential partners and investment partners a lot of the time. So we'll spend $1,700 getting that background check and then ask them questions about the background check. We'll check their references. And then a couple of strategies we picked up from others along the way would be to take somebody out for a happy hour. I happen to not drink, so this strategy doesn't work too well for me. But take them out and see what they start saying over a couple of drinks, and they might tell you what they really want to do with their life, or they might tell you about a lawsuit or a divorce, or how they're going after their past employee, or a lot of investors on our stages talk about doing that and learning more during the happy hour than the 6 meetings they had in their offices where everybody's on best behavior. People let their guard down under the influence of alcohol. And then the other strategy is to go out to lunch or dinner with somebody, and then after they order their food, you tell the waiter that this is a job interview or an investment interview, et cetera, and to mess up their order on purpose. And when it comes, see how they react. Are they super rude and get really mad and just belligerent, or do they just eat the food even though it's not what they ordered at all, or just see how they handle the situation? But most important is to see people in different contexts and see how they communicate over email, phone, in person, and just think, is this someone I trust, I like, I want to spend time with, is going to do the right thing when no one's looking, or is something off about this person? We had a deal that we negotiated over 9 months, and we were going to be given, without investing any money, 2% equity in a medical practice. It was going to grow to 5% over time. We were somewhat excited about the deal, but the founder was young, and we were about to sign the contract. And then he said something really kind of rude and off-putting. And I said, you know what? I don't know. Let's just take a break and think about it. He ended up signing the contract, sending it to us, signed, asking us to countersign. And we just walked away and said, you know what? Like, we're really busy. We don't need to work with someone who's going to be rude from the very beginning. So that means you're going to be rude to our investors. You're going to be rude to doctors you try to recruit. And like, I just don't need that level of like stress and friction in our world, because it makes me look bad if you're acting like that. So sorry for those super long-winded answers, but I just wanted to give some clear examples of like when we walk away from deals, why we do so.
No, this is really good, and I appreciate that. I've heard some of those strategies, take them to go golfing and whatever, and do something kind of unethical to see if they call you on or whatever. I've heard a lot of that, and I love what you said there. Now, this is a really good point. I'm glad you brought this up, Richard, because you went 9 months negotiation, talking, probably some resources, kind of deployed to make sure that that deal flows through. But then at the last minute, right, it's tough to walk away when you've done all that kind of that energy and effort. And I'm curious, Richard, obviously that was a learning experience to get to that point where now you have the values, the mission, the driven, like what you're focused on, what you're aligned with, and it didn't align, and you're like, hey, no, yes, no. You're very, very, black and white with that, which is really cool. I want to just talk on that specifically because that's very important, regardless if you're hiring new people for your CIO position, whether you're hiring for C-suite, whatever it is, it's a good principle. So help me understand the evolution of that process, what you've been able to establish, whether boundary systems to ensure that you do make the right decisions.
Yeah, part of it is just knowing that any bad thing that happens in your business, you can turn it into a good thing. So like me sharing that story on the podcast shows like, hey, we're not desperate to get things done. Like we're not at that level. So you can use that now with future partners to have them treat you better and you treat them well. And that's the expectation all along the way. And then the other thing is that in terms of how that evolved, I think when you're starting a business, you have this feeling of like, you just need to run after every opportunity. And then as you grow, you realize that some people are going to value you way more than others. And you may, for the same work, get 5 times or 10 times the equity or money or results working with one group versus another. And so just removing all types of friction from your life and business and having ultimate like integrity in terms of integration of everything, from like the clothes you wear to where you work to the values of your company, who you hire, the food you eat, the media you consume. The more that everything is integrated, then the more things just get out of your way and move faster. And the more you have friction, like a jerk CEO that you for some reason felt like you had to do an investment with because you already went through this process, then the more it's just people are just kind of like, oh, that's the type of people he's bringing in here. And like a good example is I just got off the line with the female physician CEO of a 2-location medical practice. It's profitable, been in business for 15 years. She's super sharp, super nice, down to earth person. And I connected her to the brother and sister investor I've worked with a lot. And I don't have any deal put together yet with the female business owner, but I was just planting the seed and showing her, hey, my network's real. Here's a couple of people you should talk to, and would love to join your board or help you grow, et cetera. And that adding the value first and just seeing how she interacts with them and vice versa, that's all part of just building the context of trust. And if you walk up to someone on the street and try to sell them something, doesn't matter how good that thing is, they'll be like, no, I don't want it. Like, no, go away. Like, who are you, right? Like without the envelope of trust, the pitch means nothing. So it means nothing. You have the best deal in the world. It means everything if I trust you, like you, know you, and I'm comfortable with how you add value,
And you guys' organization does such an excellent job because of your ecosystem, because of your community. And I want to talk a little bit about billionaires.com because you guys are doing a lot of effort on this and you guys acquired this recently. It was very, very fun. But you've been able to also interview some amazing people, like I mentioned at the beginning there, Mark Cuban, Jay-Z, Grant Cardone. You've had them on your stages as well, just to add value to your ecosystem like you do. I want to ask you this because you do an excellent job at really make sure you maximize the opportunity of your ecosystem, of the people that you're connected with, right? And so I'd love to ask you maybe mentors or maybe how to make sure that you're maximizing their time as well as your time when you are in that correspondence, having those conversations, asking the right questions, and really dialing in every moment of that relationship.
Sure. Yeah, no, it makes sense. We have different depths of relationships with different billionaires and clients, of course. And we have interviewed Mark Cuban, and Grant Cardone's been on stage many times at our events. Jay-Z and Michael Jordan are on our wish list. We have a video of them on billionaires.com, but haven't interviewed them yet, unfortunately. But you can, if anyone knows them and want to send them a text message, would love to interview them. One thing is critical is that for these interviews, we just send them 3 questions via email. And then that way they know they're not going to be misquoted. It's going to take 10 minutes of their time to answer our questions. And then we can provide them with exposure and make connections for them. So we're not asking for much of their time, and that removes friction. They don't need to get on an airplane and come speak at our conferences. If we kick it off, those 3 questions may lead to, like Larry Namer came and spoke at a fireside chat at our New York event. And we had 1,000 people there. And he was the founder of E-Channel, which sold for $3 billion to Comcast. And he was nice enough to come on stage and talk at our events. But that doesn't always happen. So we look up how we would add value to the person and then try to approach it from that angle. And sometimes it doesn't go much deeper than that. And then sometimes it leads to conducting a lot of transactions together. Like our biggest client is a billionaire that we've done 19 deals with, but it took 6 years to get to know him before we closed our first deal with him. And then other clients, we got to know a new $150 million net worth family. I'm helping them set up their family office. I flew to meet his parents, and we had a 6-hour meeting. And now, 2 months later, he's closed 3 transactions and put about $3 million to work through us in 3 different deals. So sometimes it goes relatively quickly, and sometimes it takes a little while. But ironically, doing things that are helpful and genuine and different than what other people are doing with low friction, but with the long-term intent in mind, sometimes make the short-term things happen faster, because people feel more comfortable if you're focused on the long term. And if you're obsessed with the short term, then they just push you away. They really don't want you inside their world at all.
Let me ask you though, because you've been able to really focus on the long-term strategy with these individuals, and you've been able to network with a lot of these, and they think differently, right? Where they think about time, they think about obviously money, they think about resources and delegation, et cetera. What were some of the big, biggest pieces of advice that you learned from your ecosystem through building your companies and through just building this incredible network?
Sure. One of them is I met someone once who had 25 million in revenue, 5 million a year in profits. He did no marketing, no advertising. He had no salespeople. And I said, well, how did you do that? And he had kept some of the same employees for 20 plus years. He said, well, I just find the best people possible, and I pay them more than other people will pay them. And he made it sound like so simple. But what I found in trying to incorporate that in my business is that you can't just across the board pay everyone a lot more than you are now. And so what I do is keep our base comp pretty low, but I have incentives, and some of those incentives are guaranteed incentives. Like we make sales every day in our family office club, selling a charter membership so people can come to our 15 live events a year. So it's no question that we're not going to make a sale. But if that one salesperson makes a sale, they get triple or quadruple the commission than if somebody on the team makes a sale. But everyone gets a commission when any sale is made, so they're not fighting each other. And so the point of bringing that up is that we could pay somebody 80, 90, 100, 130,000 a year, but their base pay might only be $50,000. But other people in the market may only value them at 80,000 a year. And we're able to pay them more by making it so that 50 to 80% of their comp is incentive based, not super risky, lumpy, but comes in consistently and slightly or overpaying people on purpose, but when things go well. So they're sad when you're sad and they're excited when you're excited. That's a key thing, and it's connected to what Mark Cuban said in the interview with him. He said, which people can see that at billionaires.com on the homepage for free. The whole website's free to access. He said that one of the biggest mistakes is people think they have to be a harsh jerk in business. Instead, the exact opposite is true. That if you treat people really well and give them profit incentives or equity, et cetera, and upside, then they'll be more motivated and more loyal, and your business will grow faster.
I love how you structure everything based on performance, right? And you just mentioned a little bit of that evolution, a little bit going from that, industry to obviously now with this, because what you're basically saying is that you as an organization, as well as your team, you guys are so confident in what you're capable of producing that there doesn't need to be some sort of base or whatever, right? There is a base just for, sustainability and certainty, but also being to say, hey, you know what? We grow as a company, everybody else grows, and you guys all get, access to that fund. And even when you structure the deal, because you mentioned something, I want to pull back around the royalties. Where did you learn to structure these deals? Because the creativity, what you're mentioning here, is really, really remarkable. And I love how you think about it, and I've heard some, structured deals, but it sounds like to me, it's you go in with a win-win mindset, 100%, getting alignment, identifying, asking the right questions, and then structuring the deal according to that win-win solution. And I just want to ask, like, what was that evolution look like for you? Did you learn from other people, other billionaires that structure deals, or was that just your own creativity, or what did that look like?
I think it was realizing, because besides royalties, I love strategic choke points. And at one point I realized the way to win over a 50 or $100 million net worth family consistently is to point out a strategic choke point I could help them acquire, or that they should buy or acquire. And I realized I was connecting with a little part of their brain that most people they talk to in their life don't relate to, and they don't know how to scale a business. But like, for example, we own the largest social media asset in the dental industry because we invest into dental clinics. And so we get access to deal flow, to doctor talent, to trends in the industry. And it's a business, asset in and of itself. And so relating to the entrepreneurial part of an ultra wealthy person's brain, and they know, anyone who's really successful knows it's critical to have trusted partners. It's critical to keep people accountable and have key performance indicators. It's critical to have that accountability of a salesperson doing well, then you pay that person more. And if salesperson is not doing well and they're complaining about their compensation, it's probably because your comp plan's working well and they're doing a bad job at selling. They need more training or they shouldn't be on the team. So relating to that entrepreneurial part of the brain is part of my sales pitch. I mean, selfishly, I want people to work with us more often. And so me only winning after they win or at the exact same time that they win just relates to their entrepreneurial brain on paying a salesperson. And like, okay, well, let's not pay you 85,000 a year. Let's pay you 120K, but you only get that 120K goal when I meet my goal of XYZ. And then that way I'm winning more. So selfishly, I can get paid more handsomely if I take it on the performance side, while also connecting with the entrepreneurial part of their brain, if that makes sense.
That's so interesting. I appreciate kind of unpacking that a little bit, because what I found so interesting is I was talking to someone the other day, and the way they were structuring this, where it was tiered out in a positive way, where they hit those. And I think, Elon Musk does a great job at this. I haven't looked at his deals internally, but obviously, just recently he's got a $56 billion kind of, package, because he was able to hit those 13 criteria within a 6-year period or something like that. And I was kind of looking at that, and that's very similar to what you're structuring and saying, hey, you know what? I'm willing to start with 3% equity. That's cool, with some royalty, but obviously over a 5-7 year period, hey, what does that tiered out look like? And obviously negotiating that a little bit, because obviously, hey, you know what? People love that, because hey, if you're able to boost their bottom line, wonderful, fantastic. Everybody makes more money. And the way to think about dilution is like, that's irrelevant when everybody's making a lot more money in that regard. So I appreciate what you're saying. I'm curious, with your strategy and with your kind of ecosystem, I want to talk a little bit about your family office super summit, because it's here in December, and this will probably be published before then. So that's very exciting. You have some really amazing people on here. Joe Williams, co-founder, Keller Williams Realty, Pierre DuPont Chemical Family. Everybody knows, very familiar with him. John Bowens, director of head of education, Equity Trust, 34 billions AUM. A lot of fun, really amazing people. I'd love for you to just share a little bit about that to our audience.
Yeah, sure. We have a professional athlete panel at that conference, as well as 2 healthcare and doctor investor panels. And there's more family offices on stage at this event than any other event globally. So we're really proud about that. This is our 10th year offering this specific event. And it's called the Family Office Super Summit. So we'll have between 125 and 150 speakers on stage over 2.5 days. And probably 1,500 people or so will be attending the event, and it's at Fort Lauderdale, the Westin Beachfront Hotel. And importantly, when Grant Cardone has spoken there several times, and all the speakers you just talked about, and when Larry Namer from the E! Channel spoke, who's a billionaire, and Kevin Harrington from Shark Tank came and spoke 3 times, we didn't pay any of those people anything. Last year, our keynote was Jeff Hoffman, and he's a billionaire founder, creator of the airplane check-in kiosk, and an early investor in Priceline.com. And Jeff Hoffman not only is worth $1 billion plus, but everyone in the room, it was like 70% males. Average age in the room is probably 54. At a finance investment event, he had half of the room in tears. And you don't see that too often. People usually don't cry when they go to an investment conference, right? But all these people spoke for free at my events. We don't pay their travel. We don't pay them a speaker fee. And these are all very busy people. And the reason why is it's a community. So that's what's most important. It's like, we're not a event business trying to sell you a ticket to an event. We're a community. We're an investor club. And so we're really looking to build the highest quality community we can in the family office space. And that's really the nature of the whole thing. So the event is great because there's so many connections. And what makes it most unique, though, is that if you are an ultra wealthy family office, a doctor or dentist, or ultra wealthy private investor who's not raising capital, and you're not syndicating deals or running a fund of any type, then you can just come as our guest and you come as our investor guest. If you're raising capital or running a company that needs capital over time, et cetera, or you're a service provider, then you have to pay for charter membership in order to come. But every speaker on stage is asked, what are you looking for? What do you come here to access? What are you trying to source? What's your strike zone? So by listening, by the end of the event, you've heard 125 investment mandates, structure ideas, strategy ideas, and your brain has become more specialized by coming to that one event because you heard so many different opinions on what's going on and what they prefer and what they like, and probably have 5 or 10 people that you could get some business done with. So that's what the Family Office Super Summit's all about. So appreciate you bringing it up. I didn't know you were going to, but that's awesome. It's coming up in mid-December here. And in case you're listening to this 7 years from now or 7 months from now, we at this point, we're doing 15 live events a year. And once every quarter, we have a 1,000 person conference that's a couple of days long.
Yeah, and guys, those that link will be in the description below. It's called familyoffices.com. You can literally go look at the different packages. I would highly recommend the top tier because they have incredible databases, as well as just like you mentioned, Richard, huge ecosystem, community, be able to just network, connect. And what I really enjoy about it, what I was researching a little bit, again, there's a live event December 14th to 16th, but like I mentioned on the Family Offices, you'll be able to see what the next event is if you're not able to attend in this quarter, next quarter, whatever. But one of the things is you guys talk a lot of higher level business concepts, right? It's not that, high, motivational, and that's fantastic. There's a place for that, but this is really, like you mentioned, very right down to the meat and potatoes of it. Strategic, tactics, ways to really think about things differently as well. I really appreciate you being on, man, and just unpacking this at a very high level. And I want to ask just one last question because see, Richard, just on a personal basis, in regards to your paradigm, your beliefs, that you maybe had to kind of evolve yourself, right? Certain things that maybe you hit the brick, brick wall, if you will, that you had to kind of reassess and say, there's more out of you, right? Was there someone during that journey, during that process, that came alongside you, that was a mentor, that fed into you, that said, hey, you know what, Richard, you're not living to that potential and leaving, kind of the corporate world to getting and running your own business, et cetera, et cetera. What did that look like?
Yeah, the earliest one was Eben Pagan. He really turned me on to improving myself faster and faster, and turned me on to marketing, CEO best practices, different gurus and experts, helped me become healthier. I stopped drinking over a decade ago, just as a 2-month experiment. I never really went back to that. So he really helped me do 7 figures in revenue, our 3rd year in business. And now I've been going for 15 years and been able to keep in touch with him, and really appreciate how much value Eben Pagan added to me early on. And then midway through, Dan Sullivan, a strategic coach, was a mentor to me. And I joined his top level group and spent a lot of time with Dan, directly being coached and mentored by him. So definitely appreciate a lot of his insights along the way. And now going forward, what I'm trying to do, because I have one billionaire mentor that I've done those 19 transactions with, but I'm really trying to suck in a lot of information and ideas from people through the billionaires.com. And that's kind of what I see as my kind of like building out my dream advisory board, is like interviewing these experts and trying to learn from them and adopt, what Charles Munger would call like mental models from what works in the world, and adapting the ones that work best. And so if anyone's looking for a great book, for the second time, I'm listening to Steve Schwarzman's book called What It Takes. And I think the book is pure gold, especially if you work in finance. This is what it looks like. So you can see it on my Audible screenshot there, but definitely recommend the Steve Schwarzman book, What It Takes, if anyone's looking for a great Audible book from a billionaire.
What have you learned thus far from that book? I'm just curious.
One thing is that he talks about how their core business model was M&A advisory, which is consistent fee generation, and then LBO deals, which is more lumpy fee equity gains. And those two things complemented each other, but they would also look for a level 10 partner in other niches and other industries. And if that partner had been at like Goldman Sachs for 20 years, and now they could bring them on to run a new trading desk or trading fund for Blackstone, then they would give them equity upside and do a 50-50 partnership with that level 10 person. And him talking about how the different parts of his business informed the core part. So they became smarter in M&A, they became smarter in LBOs because of all these other divisions they had. Plus it also made them more money. I could really relate to, and it reinforced some of what I found works, because our business is very different. People see us as like, oh, you run all these conferences, you're a conference business, but they don't know we have a investor relations marketing agency called pitchdex.com, or they don't know about the medical practice deals or the Airbnb fund, or that we've set up the 200 plus family offices. But these different divisions are run by different managing directors in our team, and they all inform the heart of the company. And it's kind of an octopus strategy. So when something like COVID hits, we had our best years ever, like many people were surprised to have. And, we were doing 32 live events a year before, and then COVID hit, we went to 0 live events. We had to change shape slightly to pivot. So that's probably one of the biggest things it reinforced. And then I love how Mark Cuban is so email based with communications. Phone calls take time, Zooms take time, and it's precious time. So negotiating deals and looking at deals and negotiating terms all via email as much as you can, which I've learned from a few billionaires I've worked with, instead of doing a lot of long phone calls and meetings, is critical as well.
Okay, so let's just touch on that a little bit in regard to the email communication, because I would imagine that's pretty tough, because as someone that's that knows like psychology a little bit like yourself, you would want to be in the room to be able to kind of adjust and find the weakness or find what they're looking for, et cetera, and kind of feel that out a little bit. But help me understand how you're effective with that, with email.
Yeah, part of it is that billionaires and ultra wealthy families are really busy, and so getting their attention through really concise communication that kind of grabs them with the quality of that deal. Like, for example, in our Airbnb fund, we negotiated a co-investment into a portfolio of several dozen short-term rental properties, and we got a 16.5% preferred return structure with a 50-50 profit split afterwards. And it's kind of an unheard of preferred return, so it attracts people into the deal. But even more than that is that when it's a really ultra wealthy family, I'll go out of my way to meet in person. I'll go out of my way to meet face to face. It's super critical, to, as you pointed out. But 90% of my communications are with the people trying to access these ultra wealthy families, or pitch me a deal, or running a medical practice. And so to sort through all those deals, instead of getting on the phone, I first say, can you send me your materials? How much revenue do you have? All this stuff. And they say, oh, we're a startup. Oh, it's just an idea. Oh, here's our team, we've never worked together before. Or, oh, here's our revenue, but we're losing money. And then we ask them questions, and we avoid lots of phone calls. They have to get 2 or 3 layers up before we get to the phone call mode or meeting in person mode. And that's just a massive savings of time. And I've heard Mark Cuban say, if you want to pitch me a deal, email me. Don't call me. I'm not going to call you back. Way too busy for that. And then he'll when he has time, like yesterday, flying back from Thanksgiving, I killed 100 emails off. And that's really efficient compared to trying to do, I can't do 100 phone calls, maybe in a week if I wanted to. It'd be painful. But yeah, so that's basically how we handle it. But you're exactly right, though. For the top 1% of clients and relationships, there's nothing better than meeting in person and feeling it out and building a real relationship, for sure.
And being very concise. I like that. Okay. And then also, even with the structure of it, and coming back to like the book, what it takes in regards to the structure of what you're saying. So you're saying, okay, hey, we want to make sure we get we keep the lights on, which you have some sort of monthly reoccurring of some sort to keep the lights on. Then obviously the long game, which is the equity side of things, or the revenue side of things. But also you're mentioning the kind of partnerships, the JVs, the joint ventures, the things like that, the collaborative things where you're able to get those 10 level kind of skilled individuals on your ecosystem, or partnering with them because they have their very similar ecosystem as well. And in your case, basically what you're doing with billionaires.com, those are the kind of the 10 level relationships, correct? Just want to make sure I'm structuring this correct.
Yeah, I mean, obviously, if you can recruit a billionaire to be your JV partner, that's awesome, right? Back to the real world for most of us, including myself, 99.99% of the time, it's not so much getting the billionaire as the main business partner so much as maybe, like, for example, I almost never invest in startups, but I met someone who ran a $100 million valuation fintech company for a bank. They weren't treating him well. They're paying him 7 figures. They gave him 1% equity. He was like, forget you guys. I have no non-compete. I'm going to leave and start my own. I'll do the exact same fintech company, and I'll scale it to 100 million, and he has 65% equity instead of 1%. He's 65 times more motivated. I said, okay, and that guy I will invest, because he is a level 10 level of experience doing the exact same business model, not some parallel industry or for some big corporate, but he started it and grew it to 100 million valuation. So I was his number 2 investor. And by the time that I sent the wire transfer over, he had raised the rest of his round at a 5 times higher valuation than I invested. And he sold that business to a billionaire last year, who owns a bank. And that's an example of a level 10 person. He's looking at a new venture now, and I am his number one investor. I was his first investor. So I'm excited about his next venture in the fintech space. But he's someone who has been there, done it before. He's a black belt martial artist, and his level of work ethic is like a Michael Jordan level of work ethic. Like, he will just work people under the table and destroy them, including me while working out, which I have the soreness to attest to today, coming back from Thanksgiving with him. But so that's an example of a level 10 person. I know that people listening to this don't have access to billionaires left and right. I don't have access to dozens and dozens on a first name basis, right? So I don't pretend to. We run billionaires.com because I want to learn from them and adapt their models and share what we're learning. But looking for someone who's done it before, like a dentist we found. He built 4 practices, sold it for $7 million. Then he was going to go off and like raise capital for some real estate venture. I said, why wouldn't you raise capital for dental clinics? Like, you made your money in dentistry. He's like, oh yeah, maybe I should. I was like, why don't you start your own dental platform again? And we can help bring in some of the capital and some of the doctors, and you know how to run a dental clinic platform. He already did. He's like, oh yeah, maybe I should. And so he is like a level 10 person. So we're looking at JVing with him, and we hate doing startups, but with someone like that in an industry we know really well, it's like, okay, that's something we can get our arms around and sleep at night thinking that this is going to be an excellent deal.
I love what you said there. It just, even with the dentist guy, because it's like you take something complicated. We always love to get in a different parallel, a different, kind of a different path. And just like you said, bring in simplicity and say, hey, you've already done this. You might as well just rock and roll. Man, I love this. And I appreciate you kind of explaining that, unpacking this. Richard, I really appreciate you just being on and just talking kind of all over the place a little bit, but also really just solidifying, some really main, methodologies, those principles that will stand the test of time, regardless of whatever happens in the economy in today's world or 10 years from now. This will obviously be an amazing podcast. Well, man, for those that want to obviously, reach out to you, you have tons of content out there, billionaires.com, familyoffice.com as well. Is there anything else that I'm missing? How else can they reach out to you? I'll put their LinkedIn information down at the bottom there, but how else can they reach out to you, bud?
Sure. Yeah, the core website is pluralfamilyoffices.com. And then if they want to send me a text message for anything they need quick feedback on, it's just 305-333-1155, or you could shoot me an email, richard@investorclub.com. But we've got a podcast, YouTube channel, all the normal stuff. And our whole business model is to add value first so that we kind of de-risk any potential business we could do in the future with you, whether you need to start a family office and you want our free family office management dashboard or our book, or if you're raising capital and you want our capital raising book for free from capitalraising.com. We're all about doing exactly what you're doing right here at this podcast, right? Add value to other people before you're really asking them to do business with you. So
that's awesome, man. And guys, those links are in the description. So make sure you stop here. Journey with Christian D. Evans podcast. We always take action. So make sure you stop. Like I mentioned as well, share this with your friend, a colleague, maybe another investor, whatever it may be. So make sure you reach out to them and share this content. And Richard, I really appreciate being on here big time. I always love to ask my guests, before I let you go fully, is there any last words of wisdom they'd like to share with our audience?
Last thing would be, if you are a private investor, you should be seeing some deals first exclusively and at a better valuation than anyone else, because everyone knows to send you that type of deal first. Like a multiple location, profitable medical practice deal, or a portfolio of Airbnb short-term rental properties. Like, would love to see those deals first. And whatever type of investor you are, your network should know your focus, so you see deals first exclusively and at a better valuation. So I meant to fit that in earlier, so thanks for giving me a chance to throw that in here at the end.
Awesome, guys. And that is my guest, the CEO and founder of Family Offices Club, Centimillionaires, billionaires.com, my friend Richard C. Wilson. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review, and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would
bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christianDevens.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback, and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian Evans podcast, and until next time, remember, be uncommon if you can. Cheers.